Hi, it's Bob Hoopsher, and this is the Gaining Perspective podcast, where we bring you insightful conversations with some of the top thought leaders in the investment advisor profession and investment management industry. I am the founder of Advisor Perspectives and a vice chairman of Vetify. Ned Davis Research, or NDR, is a global provider of independent investment research, solutions, and tools. It was founded in 1980, and it helps clients around the world make objective investment decisions. Its strategists and analysts use fundamental and technical research with models, charts, indicators, and weight of the evidence methodology to help clients see the signals and invest with confidence. It is headquartered in Sarasota, Florida, and it has offices in New York, London, and Hong Kong. And my guest today is Brian Sanborn. He is the global head of investment solutions at NDR. So, Brian, I'm going to have you start off by telling me about your career path, what led you to NDR, and your role there.
Perfect. Bob, thanks so much for having me on. So I've been with Ned Davis Research, or NDR, since December of 2004. Prior to starting at NDR, I attended Davidson College, where I graduated with my bachelor's degree in mathematics and economics, and I wanted to think of a way to apply both together. I ultimately decided to go to Columbia University to get my master's degree in statistics, where from there I started working at a hedge fund called Varden Capital. The principal there had worked at Tudor and very fundamentally driven, but was looking to incorporate a quantitative overlay into their investment process. And so I was helping to do just that. But one evening in 2004, it was late summer, I was watching Wall Street Week with Louis Rukeyser, and he had Ned Davis on. And so I looked up the firm and saw the reputation they had, and it just so happened they were taking applications for quantitative analysts. So I applied and ended up getting the role. When I started at NDR, I was doing a lot of programming, modeling of asset classes, as well as picking individual stocks. But two of the things I love most about NDR, one are the people and the camaraderie there. So each day getting to learn from folks like Tim Hayes, Joe Kalish, Ed Clissold, and Alejandro Grindal, and of course Ned himself, but also the entrepreneurial spirit at NDR. So as we were building out all of these tools and data sets, we were getting a lot more demand for stock selection work. NDR had been known historically for asset allocation, macro analysis. And so as we built out all the stock work, started to go out and travel and meet with clients and talk about their needs. And on the traditional asset management side, a lot of folks just want good ideas as part of their mosaic approach, and ultimately they want to make the decision of what to include in the portfolio. But as I spoke more with wealth managers and advisors, some folks obviously still wanted that, but others wanted more of a turnkey solution because they wanted to focus more on coaching their clients, financial planning, and also just going out and talking to folks trying to raise assets for their firm. And so as we engaged more with advisors and wealth managers in that space, we saw a need for delivering model portfolios. And so ultimately, I went from being a quantitative analyst to now running this product in NDR where we're delivering model portfolios either directly to advisors on TAMPs, turnkey asset management programs, or through single ticker solutions such as what we do with Dave Hagen Asset Management on the Smart Sector series. And so our model portfolios are available through those venues.
Well, our paths have intersected in a couple of ways. My daughter did an internship at Davidson. That was probably a dozen or so years ago. And we had an intern here who was also in the PhD program in statistics at Columbia, and he built some models for us. So let's talk about the models that you build. I'm interested in understanding the methodological philosophy and the approach that you and your team use at NDR. How is that implemented in your work? For example, in the models that look at the attractiveness of stocks versus bonds.
Sure. So at NDR, something that Ned has instilled in all of the employees since 1980, when he first started the firm, is to follow an objective, disciplined process. And in fact, we have 10 key rules of research that we incorporate into whether it's asset allocation, sector rotation, or even down to individual stock or ETF selection. And so the concept around all of this is not to rely on behavioral biases or rules of thumb, instead to model whether it's asset class behavior or stock behavior, determine whether or not that particular thought has worked historically based upon the actual analysis, and be disciplined enough to follow it, right? Because what's the point of doing all this work and building it if you're not going to ultimately follow a process? But there's a balance between being married specifically to your process and also being flexible enough that as new data, new techniques emerge, to ultimately be able to incorporate that into your framework. And other things that Ned has instilled in all of us at NDR, one is not fighting the tape. So the most of the money is made on big market trends. A lot of that is due to behavioral biases such as bandwagon effect or anchoring. And so you want to find where those key trends are. But also you want to see how central banks are positioned, fiscal policy, because they have major influences on the markets. And so we build a lot of indicators and models around those concepts. And then lastly, being aware of the crowd at extremes. So that really gets back into sentiment. And with sentiment indicators, valuation indicators, you're looking at extremes. So if you see overly optimistic sentiment, very stretched valuation multiples to the upside, those can be a warning sign that the trend may be getting exhausted. And so we do also include those particular indicators in a lot of our models as well. So if you think of a traditional stock bond model, you're likely to see technical indicators that look for trends on a relative strength basis between the two, but also look for the strength of that trend in terms of participation of individual stocks or sectors or markets on the upside of that trend. And then on the macro side, looking at leading economic indicators, as well as economic sentiment measures to determine whether or not the backdrop is conducive to stocks outperforming bonds. And then lastly, looking for sentiment indicators to see if the best case scenarios are even priced in, and looking for a potential turning point in that trend as well.
So when you look at all of that, the central bank policy, the fiscal policy, the sentiment, and whether we're at an extreme, what does that tell you now about stocks versus bonds?
So currently our stock selection or stock currently our stock bond models are favoring an equity overweight. And that is due to technical indicators such as stock bond relative strength. If you look at the stock bond relative strength ratio versus its 1-year moving average, at the start of the month in December, it was more than 7% above that long-term trend. Typically, when the stock bond relative strength ratio is above its long-term trend, stock outperformance persists. From a breadth perspective or equity market upside participation, looking at the percentage of all country world index markets that were trading above their 50-day moving averages at the beginning of this month, there's more than 80% of markets doing that. That was its highest level since July of this year. So not only are you seeing strong trend, but also very strong upside participation in that trend across global equities. On the macroeconomic side, we're seeing concepts such as the composite leading indicator, not only looking at levels, but also how it's changing each month. Is economic growth accelerating or decelerating based upon the composite leading indicators? That has been rising for the last 7 months. And so you have the economic backdrop supporting the equity overweight versus fixed income.
So when our listeners are listening to this and they say to themselves that the equity market, at least in the U.S., has a PE ratio of 19, the Shiller Cape ratio is 30 or more, that what you're saying is that it's more important to be looking at these relative strength indicators.
It depends in terms of the time horizon in which you're looking at. So near term valuation measures tend to be very early in terms of their predictive power. Now, if you're looking out over many years, 10 years, we have a number of charts in our service that look at market performance based upon valuations. They can be pretty predictive in terms of that risk return profile. And so are we longer in the tooth here within this stock uptrend that's been in place since 2009? Absolutely, just based upon the duration as well as where the valuation multiples are. But tactically speaking, the trend as well as some of the near-term economic indicators, although the economy may start to slow a little bit here at this time, they're still continuing to favor stocks over bonds.
So, talk about the composition now of your models in terms of the equity allocation among ETFs that are in your model portfolios. How are those structured, and what are the thought processes that went into that?
In India, we have strategists who cover specific areas. So we have someone focused on the global economy, someone focused on global asset allocation, other folks may be focused on sectors or even individual factor selection as well. So each person has their own expertise, and they're helping to, alongside with their analysts, build out indicators to determine the predictive power of those indicators for their particular coverage area. We also then have a custom solutions team at NDR that builds all of our core models. So NDR actually is an RIA, even though we don't manage external assets, but it allows us to provide custom advice to individual firms. And so the custom team builds all of our core models that combines the best insights from our strategist while taking into account things like correlations, right? So you don't want to have the high correlations across your indicators because then you're basically betting on the same theme over and over again. So they're doing all this analysis, building these models that ultimately then get put into our production environment. And in terms of the ETF model, when we looked at that top layer of determining whether to how much to allocate to the all country world index versus the Bloomberg Barclays Global Aggregate, we're using those technical indicators such as the relative strength, global equity market participation, as well as macroeconomic indicators such as the composite leading indicator. Also looking at things like the Baltic Dry Index, global shipping rates to determine the health of economic growth, economic sentiment in terms of the Purchasing Managers Index, which are surveys done of purchasing managers and their outlook for things like new orders, inventories, deliveries, employment. And so that's done on a economy by economy basis. So we're actually looking for the percentage of economies that are in an expansionary mode based upon economic sentiment versus in contractionary, and looking at how that's changing and evolving over time. And so as more economies show a healthier economic outlook, that tends to favor stocks over bonds. And then lastly, we also look at the bond market itself, in particular looking at global high yield option adjusted spreads. When spreads are widening out, usually just indicates that fixed income investors are just losing their risk appetite. And so typically when you think of stocks versus bonds, stocks are actually are riskier on average. And so it tends to mean on a relative basis, fixed income outperforms. Whereas when spreads are narrowing and fixed income investors are getting more risk appetite, usually stocks outperform bonds during those periods. And so those are the key 6 indicators that we found for our ETF model to help determine that, again, ACWI versus global ag allocation.
You mentioned earlier that you're favoring stocks over bonds. Is that a reflection at all over widening spreads in the bond market?
So, entering the month of December, um, we had seen that spreads had widened out a little bit in the fall, but had then started to reverse back in November, and we're very close to that threshold where we would actually say they're now favoring stocks over bonds, and subsequently, intra-month that indicator has actually flipped, and now on an intra-month basis does favor a stock over bond allocation.
You mentioned you do work in factor strategies. Describe what you do there and how that plays into your forecast for market performance.
Right. So as we were looking to build out our stock selection work, a number of folks look at factors and think just value as an aggregate or growth or momentum or quality, which are perfectly reasonable buckets to put these concepts within. But being a research service, we want to give our clients a little bit more flexibility in terms of defining those individual characteristics. So we ultimately built out a pool of about 200 different characteristics that look at fundamentals, such as how efficient a company is in generating earnings or cash flow, quality of those companies, not only earnings quality, but balance sheet liquidity, as well as earnings stability over time. We also looked at technical metrics, trend, momentum, overbought, oversold, sentiment metrics, things like short interest, valuation metrics, and then lastly, macroeconomic sensitivity. So we calculate how sensitive a particular stock is to inflation or to industrial production or currencies and commodities. And so we built all these individual factors up and then created portfolios based upon each of these factor characteristics or attributes that basically show how companies with higher attributes have performed relative to companies with very weak attributes for those particular characteristics, and then track the performance over time. So for many of these individual characteristics, we go back to the early to mid 1980s to see how they've held up over time. And then we look at those factors not only over the long term, but also how they've held up during different macroeconomic regimes as well as market cycles. And so that's ultimately how we built up our stock selection work. And what's interesting is you can see what drives stock returns does evolve during different periods, but also there are a handful of those factors that have really stood the test of time and that have held up over the long term.
When you look at what does drive stock prices over the long term, what is it? What is the strongest driver of long term performance?
The strongest factor over time has been free cash flow to enterprise value. And the other four characteristics are kind of tell a story around cash flow. So cash flow is the lifeblood of a company. Company's not producing cash flow, it's not going to be around for the long term. And performance around those characteristics has shown that to be true over time. In terms of the five factors, so free cash flow to enterprise value, that's just measuring how the market is pricing in or valuing a company's cash flow. So again, you just don't want to pay for companies who have very expensive valuation multiples when you think of their free cash flow. But in terms of the other metrics as well, another concept is operating cash flow efficiency. That's looking at operating cash flow normalized by the assets of a company. It just shows how effective a company is in using its asset base to generate cash flow. Another metric is um, more of a quality view on a company. It's looking at the earnings quality. It's called the accruals ratio. So it looks at earnings, the difference between earnings and cash flows normalized by assets. It was a concept that was made pretty popular in the 1990s by Sloan and Chow. It became more prevalent in the early 2000s when you had all the accounting scandals out there. And basically, what they found in their different studies was that companies that had a very large spread between their earnings and cash flows tended to use different income recognition tactics or accrual cost accounting that were not optimal for a company. And so usually if companies with lower accruals tended to outperform. Another metric that really popped out that again is tied back into overall cash flow is how a company rewards its equity shareholders. And we measured that through a concept called shareholder yield. And that was made popular by William Priest about 20 years ago. And that combines concepts such as dividend yield as well as net repurchase yield. So looking at the repurchase of a company, subtracting out the issuances, and then also net debt reduction yield. So looking at the difference between debt retirement versus debt issuance. And so if a company is paying out dividends, retiring equity shares as well as retiring debt, those all benefit an individual equity shareholder. And then the last concept is price momentum. So in other words, the company is generating a lot of cash flow efficiently, rewarding its equity shareholders, reflecting it through their quality of earnings. Is the market rewarding that? And if the answer is yes, that's a really good sign. And so when we looked at those characteristics, not only did they have favorable performance over the long term, but also when you look at the returns to each of those portfolios based upon those metrics, the returns were relatively moderately correlated to each other. And so when you think of portfolio construction, if you've got favorable returns, pretty low to modest correlations, that is a really good recipe for building a portfolio. And then one other thing we did as well, this was originally all in the US, we then expanded this work and looked at other markets, Canada, UK, continental Europe, as well as Japan. And we found that these characteristics also held up in those markets as well.
So when we look at free cash flow to enterprise value, and along with some of those other metrics that you mentioned, like operating efficiency and accrual ratio, shareholder yield, price momentum, what are the stocks that you think will provide the best returns in 2024 based on those long-term drivers?
So one thing before I mention the individual names is a little caution on the approach. With this type of quantitative approach, it is intended for more of a basket view. So it's not intended to pick off one or even a couple of names. And the main reason is if there's some type of stock-specific or idiosyncratic event that occurs, such as an issue around the accounting recognition or some type of macro event that uh, can supersede all of those factors that we just talked about, you just have to be a little bit careful. Whereas if you buy a basket of names that have all of these attributes behind them, even if one or two stocks has an issue based upon some anomaly, it's not going to torpedo the entire portfolio. So that's just one word of caution. In terms of the individual names that pop out, the sector representation is pretty broad. So there are names from communication services, energy, materials, industrials. The two sectors with the largest representation were consumer discretionary and information technology. And the names include some of the mega cap companies like your Apples, your Alphabets, Exxon Mobil's of the world, and also companies such as TJX Companies, Booking Holdings, Parker Hannifin, Marathon Petroleum, Accenture, Visa, CBOE, and Cisco.
And is this an exercise that you do every year in terms of identifying what the basket of stocks that you're predicting for outperformance in the coming year?
Absolutely, and this is something that we also provide to our clients. So these data sets, as they update, we do make them available to our clients so they can actually look at the names and track them over time. And we even publish this list every month. So clients looking to deploy capital or any cash that they're getting from their clients, they have an updated, refreshed list of names that they can use.
And what's your track record been? How good have these picks been?
Yeah, so we publish that on the NDR website, and I do have to be careful about referencing individual performance just because we're an RIA. But everything is on the NDR website.
Well, great. We're going to provide a link to that website in the notes that accompany this podcast. One thing that sticks out in everyone's mind now is the potential for a recession. There are signs the economy is slowing. There are growing number of bankruptcies, particularly among smaller companies. Uh, we still face the geopolitical risks in the Mideast and the Ukraine. How would a recession change your view of stocks versus bonds or any of the stocks that you picked?
So let me start off by saying, in terms of recession itself, our economists are still showing a less than 50% odds of recession next year. They just published their outlook report for our clients that just came out the end of last week. We also have models that we build on individual economic time series as well as just the broad economy itself. Our US recession probability model is currently showing less than 20% odds that a recession is imminent. But that being said, you're right. That's one of the common questions we're getting from our clients: soft landing versus recession. If we were to have a recession next year, when we look at first asset class level performance, typically longer duration bonds outperform stocks during that type of period. And you can see the performance of TLT as an ETF over the last 2 years. It's really been hit pretty hard and strongly oversold over that time period. A recession could lead to a potential bounce in that particular ETF. The one exception would be is if we do have very weak economic growth, but inflation then starts to pick up. In that case, all bets are off. Stocks and bonds historically have both had a pretty tough track record during such a period. If you can, during that type of environment, the areas that have historically done best are commodities. So there are now more no K1 ETFs out there they can use to play the commodity space. And also shorter duration bonds, especially cash, tend to do okay in that environment. From an individual stock perspective, there are two ways to think about it. If you are not looking to be too tactical here, those long-term drivers that we spoke about at the beginning have held up over the last 40 years, including periods like the tech bubble bursting, the global financial crisis, as well as even the COVID shutdowns. So they've held up over the long term, and so that's always a good place to start from a core portfolio construction perspective. However, if you're looking to be a little bit more nimble or bolt on a satellite view to that core approach from a stock perspective, during recessions, historically, that's where you get your worst bear markets from an equity perspective. During those periods, it's a flight to quality. And in particular, you see concepts such as greater profitability as measured by higher return on equity, quality metrics such as companies with very steady earning streams or low earnings volatility, as well as concepts such as interest coverage, companies that have higher interest coverage, less likely to default in those periods. Some of the stocks we already mentioned earlier have those characteristics. So companies like Apple, Accenture, Visa, CBOE, and Cisco. So they have not only long-term core drivers, but also have some characteristics that on a relative basis tend to hold up during recessions.
Most of our advisors who will listen to this have clients who are in the accumulation stage of investing. They're planning for time horizons of at least 10 and often 30 plus years. If there's one key takeaway that you would like to leave with those advisors about how they should position portfolios that are in the accumulation phase with long term horizons, what would that be?
So we have some charts in the service that look at performance of stocks, bonds, other asset classes going back basically 100 years. And over 10, 20, 30-year periods on a rolling basis, both stocks and bonds have almost always had positive performance. And so I think my suggestion would be to really follow the NDR approach of being objective and staying disciplined. Uh, Especially like the past couple of years, we've seen folks maybe overreact to near-term market behavior and dramatically shifting portfolios according to that. Instead of taking a step back and really just looking at the data over time, it's tough to live through it. It's tough to overcome those behavioral biases, but making sure that you're not sitting in cash, or significant amounts of cash for long periods of time because markets tend to appreciate over the long term. And it's a trap we've seen folks fall into. And so relying on your own behavioral state to try to either pull cash out or deploy cash during the different market environments or macroeconomic periods is very challenging to do. But having an objective framework in place that can help you do that and take the emotional aspect out of it is in my opinion very preferred, because I know for me personally it's very tough to manage my own portfolio. Your emotions can get the best of you. So having that uh, quantitative background or quantitative framework to help take that off your plate is a important aspect. And one of the things that we're also trying to do for advisors and wealth managers in the States is provide a service that helps them do that. So we actually now have, if you go to ndr.com and there's a page at the top called Wealth Services, there's now a complimentary offering for advisors, as long as they accept the terms of services, that gives them educational charts, talking points, perspectives on the markets and economy, as well as some screening tools to even run some of the things we talked about today, just to help them with really reducing those behavioral biases.
Great. Well, we will provide a link to that ndr.com homepage in the notes that accompany this podcast. And I did actually go on there myself last night, signed on as an advisor to be able to familiarize myself with your latest research. So it is very easy to do. Brian, is there anything else you'd like to add?
Thanks for having me on, Bob, and go Yankees.
Brian and I are both New York Yankees fans. Thank you for listening to the Gaining Perspective podcast with Bob Oupsher, today featuring Brian Sanborn of Ned Davis Research. To support our podcast, please share, subscribe, or leave a review to help make our podcast more findable for your friends and colleagues. You can subscribe to Gaining Perspective on your favorite podcasting service.